Google just destroyed their earnings and they have recently announced a new 20-for-1 stock split. So is it the right time to buy the stock at the moment or should you wait to buy the dip? Well, in this video, I will share with you what is my personal opinion on this stock and what is its current intrinsic value. Stay tuned until the end of the video to see my new tool that I've just developed to be able to calculate the future value of a stock. First, let me explain to you what is the impact of this stock split on the valuation of the company. Don't get fooled by this newbie trap. A stock split doesn't create any new value. What it makes is that it just creates more shares for the investors, but with the same value. So the shares are going to be at the lowest cost, but the value of the company will stay the same. Just to illustrate this concept, we can say that we have a pie. And what we do with the stock split, we just cut the pie in 20 different parts. So we have the same value of the pie, but we have 20 parts instead of one big part. And of course, it creates more liquidity in the market, but also more marketability, which means that the average investor will be more able to buy it and it will be more affordable for them to buy the stocks at this price. If we come back to the company, Google is currently the fourth biggest company in terms of market cap with more than $1.8 trillion of valuation. Before to invest in a stock, I always try to understand what is the business model of the company. It means to understand what are the products and services offered to the customers and also how does the company makes its money. In this case, Google offers many different products and services to their customers. Since you are watching this video, it means that you are using presently one of their services, which is YouTube. YouTube is currently the second biggest social network with more than 2.2 billion active users monthly. But Alphabet business model also includes many other different services such as Google Search Engine, Chrome web browser, Gmail, Google Cloud, Android, Google Play Store, Pixel cell phones, and Google Maps. Alphabet also invests in smaller companies which are considered as their bets and which include Waymo, Verily, and DeepMind. Most of Alphabet revenues come from Google services, which includes Google Search, YouTube, and Google Network Ads. This represents more than 80% of their revenues for the third quarter of 2021. They also earn revenues from Google Cloud and their other bets, which often represent smaller companies bought by Alphabet. Looking at the operating profits, we can see that Google is only making positive operating earnings from Google services, while Google Cloud and small bets are still not making positive income. However, we can see that since 2020, their operating income has been increasing. And as I told you earlier, Google has totally destroyed their earnings and they have been able to surpass all the different indicators, just like the EPS, the revenue, the YouTube advertising revenue, the Google Cloud revenue. However, on the traffic acquisition cost, it cost them $1 billion more than what was expected initially. Also, Alphabet have been able to report an incredible revenue growth of more than 32%, which also proved the fact that they were able to withstand all the pressures from the pandemic and the inflation. And an interesting point is the fact that the stock has surged 65% last year, which beat the return of all the big tech companies in the S&P 500. Google would also have enough cash and liquidities to be able to pay all the total liabilities of the company if they had to. This also means that if the government started to taper even more money in 2022, this should not have much impact on Alphabet since they have way less debts compared to its competitor. Talking of competitor, Alphabet doesn't have only YouTube that performs very well. Its Google search engine is currently a monopoly in the field. Indeed, more than 90% of all the searches made on the internet are made from Google search engine. Its closest competitor is Bing that only owns between 2 to 6% of the total market. This means that as the digital advertising spending are set to increase in the future decades, Google could be one of the companies to enjoy and to take advantage of these news. And at the moment, Google and Facebook are both a duopoly in that sector, which means that at the moment, the advertisers are spending most of their budget in Facebook and in Google Ads. However, Amazon has been pushing hard these past years to enter in that sector and to become a huge actor in that field. So it's going to be really interesting to see in the future years and in the next decade how all of these companies will perform. Another huge possibility for Google in the next decade will be with their cloud computing segment that is currently increasing. For those that wouldn't know, a cloud computing is the delivery of different services through the internet. These resources include tools and applications like data storage, servers, databases, networking, and software. Since these kind of activities has increased throughout the pandemic, Google is currently at the third place in this sector, just behind Amazon and Microsoft Azure for the fourth quarter of 2021. With the increase of the tech in all the different sectors of life, I think that there will be a huge possibility for Google for the years to come. For my prediction of the valuation of Google stock, I have created a quite simple Excel spreadsheet to help me with that. And right now I'm also working on a more complete spreadsheet that will be pretty useful using the DCF, the discounted cash flow method, with some basic assumption and with some different scenarios to be able to calculate more precisely the valuation of any kind of stock. So I'm working on that, but for the video, I'm going to present to you the simple spreadsheet. So first of all, as you can see, what I just first take is I'm going to go on Yahoo Finance. I take the earnings per share and the P ratio of the stock. And if you remember well, when you multiply the P with the earnings per share, it gives you your current price. So in that case, I put both of these information there. And after I'll just go take the growth rate that is predicted by the analyst on the next 5 years. So for Google, it's about 27.56%. So it is a lot of growth that is estimated. So I took it there. And after I just determine what is my minimum rate of return. In that case, it is about 25%, so quite higher, as you can see, than, for example, the 10 to 15% of the S&P 500. I put it there, and I'm using a margin of safety. Later in the video, I'm going to share with you how it works. So first, I just predict the earnings per share for the next 10 years. In that case, it's a quite simple calculus that you need to do. It's just you take your first earnings per share, you multiply it by the growth rate, and it gives you that in 10 years, it's about $1,000 of EPS that I personally predict. And it gives you also you can after just multiply it with the P, you find your price in 10 years. So it's about $24,000 per share that is predict in 10 years with this method. And your current price that is predict also, it's about $3,200, which is higher than the current price, as you can see. So right now it would be undervalued, as you can see. And with the analyst price target, we see that I'm pretty close. I'm slightly lower than what is predicted by the analyst, but I'm still quite close from it, and with a margin of safety. So if we were to see a huge market crash, for example, of 40%, the price would be potentially about $1,300 per share. And at that time, I would be loading up, so I would be buying a lot of shares. So I'm going to do a little SWOT analysis before to give you my personal opinion on the company. For the strength of Google, obviously Google is currently a huge leader in its field, notably with the Google search engine being the number one in all the market with a dominant 90% of the total market. Google and Alphabet also have some incredible strong brand, so it represents something. It also has some of the finest technology on all the market, and also they have some incredible revenues and revenue growth since the past years. However, for the weaknesses, we have seen that Google in the past have been depending a lot on their advertising revenues. That could be a really big threat, especially in the past years when we've seen the rise of some ad blocks softwares. They have also faced in the past a lot of problems with their privacy policies. For the opportunities of Google, in the past years, they have been able to expand their brands, notably on the wearable market with the creation of the Fitbit. They are also trying to diversify all their revenues to be able to face the problems that I've told you earlier, that they were depending a lot on their advertisement revenues, since they are trying to buy a lot of different companies and try to develop a lot of different products. And finally, as I told you earlier in the video, they are currently working on their Google Cloud segment to be able to develop it as much as possible, because I think, and they probably think the same, that in the future it's going to be a really important sector for our economy. And finally, for the big threats of YouTube, first, there is a lot of competition in the market. As I told you earlier, some actors like Microsoft, Amazon, and also Apple are threatening, I would say, Google in that sector. And there is also a lot of political risk, for example, with China, that if Google were trying to expand their market in that place, it could be hard for them to be able to be successful in the future. And now for the moment you have all been waiting for. Yes, I think that Google or Alphabet is a great company to buy at the moment, but also in the future for the next decade, since I think that it has a strong core business. Add with that, I think that as you've seen earlier, there is a lot of potential growth that is predicted for the future by the analysts, but also by myself, knowing the fact that this business has a really strong business model, since it has a lot of customers all around the world, but also it has some strong products and services that are really well diversified in my opinion. And they are also depending less and less on the ads, which is a really great news for this kind of company, knowing the fact that there are some threats in this sector. So I personally think that this stock is a really great buy for the long term, especially knowing that there's going to be a huge stock split of 20-for-1 in the months to come. So I think it's a great time right now, knowing the fact that it's a little bit undervalued at in my personal point of view. And guys, you know that there's not only Google as one of the top tech stocks, there is plenty of them, and the new Meta generation will be really interesting to see. And that's why I invite you to go check out my last video on what are the top 3 Meta stocks that you should buy for 2022. It's gonna be just right over here, and I will see you there.